Okay, so week 3, class 2, and probably the last class of the analyst section, probably. So we'll be looking at entry candles, high and low of the high timeframes, daily, weekly, monthly candles, multi-time frame correlation, and top-down analysis. So let's look at entry candles first. So entry candles are used as a confluence to enter a trade at an area of supply demand areas only, right? Because it's an entry candle, and that's where we take our trades from, an area of supply or demand. And main thing to remember here, entry candles are only going to be used when it comes to market execution orders. So market execution orders, limit orders, and buy orders is something we're going to look into deeper in the MetaTrader section, which is probably next week. But market execution, to give you a gist of it, is basically means that you're entering the market immediately. You're not setting a pending order. So we will focus on the higher probability patterns, the entry candles, which is shown in the examples below. The lower and medium probability examples, I'll give you a few examples on the chart, what it means for an entry candle to be a low or a medium probability. So we have two types of entries. We have a conservative entry candles, and we have an aggressive entry candle, right? So first, we're going to look at conservative entry candles. And the ones that I like using is quite simple, and bullish engulfing. And a bullish engulfing, till now, you should know what it is. It's quite simple. Bullish engulfing is when, if you notice this example right here, yeah, bullish candle closed above the high of the previous bearish candle wick. So not only that the price went above the wick of the previous bearish candle, also the body of the candle closed way above, right? So this here is a higher probability bullish engulfing. A low probability or a medium probability bullish engulfing would be, I'll give you an example. Hold on. So let's look at maybe USD JPY here. Okay. So let's see. Okay, so maybe here, possibly. So look at this candle here, right? So you see the wick of this candle and this. This might not be the best example. Hold on, let me give you a better one actually, because here I see a lot of heavy movement. Hold on. Okay, maybe this could possibly it. Okay, so let's see. Look at this one, yeah. Look at the wick of this candle. Look at the wick of this candle. Look at the body and the body of this candle. Notice the body of the candle it closed right where the wick is. It didn't close above the candle, right? Where the above the last wick, which is this. So this here is a medium probability engulfing, or you can even call it a lower probability. And what does that signify is that buyers couldn't push price and close price above the wick of the previous bearish candle, right? So that tells us the bears, right, the sellers still have some form of control. Therefore, price actually closed off where the wick was. So this here, if you even look at the price action, what happened? You see how that wasn't the best bullish engulfing? Price actually followed through bearish instead. So we want to see not only price close above the wick, also the body of the candle close above for a bullish engulfing. Yeah. So let me see if I have one more example here. Okay, let's go down to a lower time frame. Maybe we have a few more examples here. Hold on. Okay, possibly. So we have a lot of heavy movement in this pair here. That's why it's a bit difficult, but okay. So, okay, if we can possibly see here, which is pretty much the same thing here, right? You see this candle and see the body of that candle, the bullish candle. See how the bullish candle closes right at the wick. Doesn't close above. The body of the candle doesn't close above. And that right there is a medium probability or a lower probability engulfing, right? So the main thing here is to know we focus only on the higher probabilities. We don't care about the medium probabilities. And engulfing like this at an area of supply demand, we would still not take the trade till we see a proper candles close above, right? And that would be an entry candle for us, a conservative entry candle for us to enter the trade. Same goes for the bearish side. Let's see the next slide here. So yeah, bearish candle. Here in this example, bearish candle closed below the low of the previous bullish candle wick, right? You see how the body is completely closed below? That shows you this is a high probability bearish engulfing, right? So let me give you an example here. Yeah, we have an example here. You see this wick, look at this wick, look at the body here. You see how the candle hasn't closed below the wick of the bullish candle, right? The body of the candle. This is technically an engulfing. Yes, the reason why this is an engulfing is engulfed the body, but it hasn't yet engulfed the last low, the wick. If this had been engulfed, this would be a high probability bearish engulfing. Yeah. So this isn't a candle pattern that we will look at. We just like high probability, right? At the end, we deal with probabilities. We want to see if the price can give us enough confluences so that we can take the trade. So those are the single candle, right? These are the single candle patterns. Now we'll look at multi-variation patterns. So multi-candle variation pattern is the second entry technique I like to look at when it comes to the conservative entry, right? We yet haven't done the aggressive part. So multi-candle variation we have, which consists of 2 to 4 candles in a formation, right? So one, we see a bullish variation pattern. The third bullish candle closes above the high of the first bearish candle in this example. You see how the second candle here gave us a bullish engulfing, but we did not see that closure happen above the wick. But the third candle actually closes above the wick, right? So we would probably take our entries once the third candle has closed, and that would be an entry for us. So just like that, or the bearish variation pattern, you see the third candle there, it closes below the low of the first bullish candle, right? Because the second candle is nowhere, that doesn't even have an engulfing. The third candle gives you that variation that you want, right? So if you look at a few examples here. So let's see. Okay, so we have one here. Notice the wick of this candle and the wicks and the bodies of each of these candles right there. Notice the bearish candle. Notice the second candle is the bullish candle, right? The body of the bullish candle doesn't close above the wick, so this isn't an entry signal yet, right? But the third candle, we see the body of the third candle close above the wick of the seller candle, right? The bearish candle, and this is a bullish variation pattern. We have a 3 candle variation. Therefore, this here is a higher probability signal to enter a trade, right? A conservative entry. All right, let me give you one with the bearish example here. Okay, we have one here. So notice the wick of this, and this, and look at the bodies of the candle. Notice how the second candle doesn't close below the low, but the third candle destroys all these lows, right? Especially the first bullish candle's low. And we have here a bearish variation pattern. So this is a bearish variation pattern that I like to look at, and a higher probability bearish variation pattern. So these entries, you need to take them at an area of supply or demand. That's it. That's where these entry candles function comes into use. Yeah. So the pros, right? The advantages of using a conservative entry. It is higher probability because you're waited for a confirmation. You saw where the buyers and the sellers volume was before you entered the trade, right? Therefore, it's a confluence to enter our trade. Might help some traders with the psychology to wait for a confirmation candle. This is something I struggle with. When I realized that I was waiting for my confirmation candle, my psychology would be a bit easier. It would be, I would be more willing to hold a trade. But the cons, when there's too much volume in the market and candle prints a massive engulfing candle or a massive variation pattern, you cannot take an entry, as an entry is way too far from your supply demand area. This is an example I'll show you in a minute. And also, risk to reward is sacrificed due to you waiting for the candle to close. This is caused due to a bigger stop loss, right? So an example, like this is a great example, yeah. So we have look at the wicks and look at the bodies of the candle, and this is a bullish variation pattern. But the issue here is, you see how the third bullish candle, the massive bullish candle, it closes way above. The volume is too big, right? So if you had waited for the third candle to close and you place your entry at the close and your stop loss below here, you see how massive your stop loss would be, right? And if you had to just take profit, let's say somewhere here, right? See, your take profits is a 1-to-1 pretty much, right there. But if your entry was all the way down here, you would notice how massive your take profit and your risk reward is. So it makes a difference, right? So when you see, if you're someone who likes to wait for a confirmation entry, if you see a candle like this, just don't take the entry. I know it's a bit frustrating to wait for your trade and then see a confirmation such as this, but this doesn't mean you should be entering the trade. I would like to see the body of the candle probably close somewhere around here, right? That way, at least my stop losses isn't too big, right? But this candle is way too big for us to be taking an entry. And obviously your risk reward is also sacrificed. So that's why I think those cons are probably one of the main reasons some people do not wait for a confirmation. Yeah. Okay, so this is the second entry technique. Very simple. Aggressive entry candle. We like to see a massive rejection candle when it comes to the bullish or the bearish. So when it comes to the bearish rejection candle, you notice the wick, the first example, the photo on the right. Notice the wick, right? This wick has to occur at an area of support or a supply demand zone. Or this wick also indicates what? It indicates there's a lot of buyer volume and a lot of sellers exhaustion. Sellers are exhausted, right? They can't push the price down, and buyers took over aggressively. This here is an aggressive entry, right? You would take an aggressive entry without waiting for a bullish engulfing or a bullish variation pattern. You would straight up take an entry once you see this candle. And also vice versa, you have your bearish rejection candle, which is the same thing. It's a rejection at the resistance or your supply zone, indicating seller volume and buyer's exhaustion, right? So let me show you an example. Let's actually do something. Let's mark off just one zone of supply, a support or a resistance, and see if we can find one. So we have one at 145. And notice the zone. When price does come towards the zone, what happens? You see this candle here? You see how huge the reaction was of that zone? If you're trading on this time frame, after seeing this particular candle, you're going to be taking an entry. And an entry would have been something like once the candle closed around here, right? With the stop loss below the wick right there, and say you take profit was here for 36. Look at the risk to reward, which is a 1-to-4, right? But if you had waited for a confirmation entry, which is your second candle, a bullish engulfing, look at what happens once the candle closes and you have a stop loss at the same area there, and you take profit about right there at the same area. See, your risk reward is just a 1 to 1.78, and on this you have a 1-to-4, right? A massive difference. But the risk reward, you don't have to chase greed, right? I know a lot of traders would just take confirmation entry and wait for, and still have decent risk reward, but not as much as the aggressive traders, right? So here I would like, this comes with experience. I would suggest to practice both. That's the only way you'll find out your own psychology. So someone asked if aggressive is an instant or a market order. No, that doesn't mean. Market order is completely different. Market order is related to the execution of your order. Market order means you're placing an order now. That's simply what market means. Like if I see prices around here and I've entered immediately, that's a market order. But a limit order or buy order is an order that I have placed here in the future and then price eventually comes and hits it. It's a pending order. But an aggressive entry and a conservative entry are are different things. They are just an entry signal for you to possibly enter your trade aggressively or in a conservative fashion. Yeah. Okay. So those are your entry candles. So your pros when it comes to this entry candle, aggressive entry candles, it does give you a perfect entry closer to your supply demand zone. Risk to reward is big, which I showed you, due to your entry and smaller stop loss. You have a confluence, obviously. The cons here, it's a lower probability compared to a conservative entry, as we did not wait for a candle confirmation, right? So there's a lower probability here. And because of that lower probability, it can affect your psychology in some traders, and fear may kick in. You might be right. You might have seen the candle and you might have been right in the trade. But just knowing you didn't wait for confirmation can mess with your psychology, and you end up closing the trade even though the trade went in your direction. Yeah. So now, depending on your entry technique, we can decide on appropriate risk percentage for the trade, or maybe even splitting the risk between different positions or scaling in positions. Different positions and scaling in positions is something we'll look into deeper once we go into the course, and also the risk management, of course, which I mentioned here. We will discuss this in the risk management section. I know some traders who would maybe say, if you want to risk $1,000, right? They would probably risk $500 on an aggressive entry and then wait for a confirmation and then risk the next $500, right? Instead of risking everything in just the first position. You can split those positions. So that's your entry candles here. And very important here, the entry candle time frame. So I get this question a lot. Depending if you're a scalper, a day trader, or a swing trader, the entry candle confirmation will be dependent on particular time frames. So a scalper would be looking to take an entry, looking at those entry candles on a 1 minute to 5 minute time frame. A day trader on a 5 minute to M30 time frame, the 30-minute time frame. Swing traders will probably be looking at this as a 30-minute or even a 4-hour time frame, right? So depending on the time frame you take a trade on, the stop loss distance will be affected, even your take profit. Obviously, right? Your duration of the trade is going to be different, of course, right? Depending on your time frame. The entry candle weight. So the entry candle weight, what I mean by this is, the higher the time frame you're taking the entries off from, the stronger the probability of the trade. Because the higher the time frame, that shows you the accumulation of the buyers and sellers sentiment for those time frames. But not something you need to be concerned with, but something to keep in mind. Psychology can be affected depending on the time frame. Higher the time frame, more stable your emotions are going to be. So if you're a scalper and you notice you have a bit of anxiety or so, it's because of the time frame, and maybe your personality type doesn't suit it. Maybe you are a swing trader. You like to take your trades nice and smoothly, wait to react, right? You're not too reactive. So probably you'll be taking those entries on a higher time frame. So something very important, everyone keeps asking me, which time frame exactly would be the ones that I'll be using on which pairs. So something very important to keep in mind, more volatile a pair, the higher the volatility of a pair, the lower the time frame you're going to be using to take an entry. Very simple. Higher the volatility, lower the time frame. So lower the volatility, higher the time frame, right? Because at a high volatility pair, the pair moves very quickly, right? So you have to take those entries a bit quicker than a pair where the volatility is much lower. Because when a player is lower in volatility, we want to wait and see the seller and buyer's sentiment on a bit of a higher time frame. Because on a volatile pair, we can see those sentiments in a lower time frame quickly. Yeah. So someone asked if gold would be the best. Yes. So me personally, I like to, if I was going to use an entry candle, I'll be using the 5-minute entry candle on gold, because commodities is quick, and indices probably from the 5-minute all the way down to the 1-minute time frame. For forex pairs such as GU or GJ or even euro, right, US dollar, I'll probably be looking at M15. So the higher volatility for forex pairs, GJ and GU or so, I'll be looking at the 15-minute. But for a lower volatility forex pair, which has high liquidity, such as euro and the US dollar, I'll be looking at the 30-minute time frame, right? Because the volatility is low. So you got to fluctuate your entry candle depending on the volatility of those pairs. Yeah, it's very simple. All right, so that's with your entry candles there. So let's look at high and low of the daily, the weekly, the monthly candles. So this is a confluence, right? This is the confluence that we use. This confluence is used to enter trades if a high or a low is at a supply demand level or used as a bias for a trend confirmation. Me personally, I like to use it as a bias. Yeah. But is this something you can keep an eye on? A lot of traders use the highs and lows of these bigger time frame candles to enter trades, and they are quite successful. Depending on the trend, when a high or a low of a candle is broken, a lot of volume starts kicking in, which increases our probability of a trade, because when the volume kicks in, it can go in our favor much quicker. This does not always work, which I have mentioned, but can be used as a confluence for our trades, right? So an example down here, if you look at the first photo right there, that is your weekly candle. So I've marked off the low and the high of the weekly candle, and the second time frame here is a lower time frame, right? I went down to the daily or the 4 hour time frame here. I think this is the daily time frame. So the daily time frame went down and showed you how that actually played out. So you saw the low right there and the high right there of this candle there. Notice what happens here. Once the low of the previous week breaks, you see how the volume starts kicking in like crazy. A lot of volume starts kicking in. So that shows you that these areas have some form of confluence, right? Some form that a lot of traders depend on certain strategies when it comes to those highs and lows. So this low here shows you that a lot of sellers enter the market once the lows broke, right? And probably could be a bias that you could use when you're doing an analysis. You don't even have to use it as a entry signal, right? You could use it as a bias, so that okay, the low of this candle has broken through from the previous week, right? Maybe the seller's sentiment is coming in stronger this week, possibly. So let me show you a few examples here. When it comes to the low and the high, let me use this chart itself here. Probably let's use a weekly time frame. Okay, so let's look at this bearish candle. So let me mark this off. Where is it? Okay, so this bearish candle, let's mark that off, and this occurred on 5th of June, right? 5th of June, right there. And if you go down to our lower time frame, let's go to the daily time frame. And if you notice the high of let me draw a line here. That was the high, right? And notice what happens when the high breaks, truly breaks. And you see how we had a wick here, right? Possibly there could have been buyers when this high broke through initially. A lot of buyers started buying up, and the liquidity of these buyers got shot off, right? Because market makers pushed them down and closed them off below the low. But eventually, when the price again on the second day after this breaks through, see the volume which kicks in. That's a lot of volume in the market, right? And if I had to combine this, let's see if you can combine this with your entry candles as well. Let's say we went to a 15-minute or a 30-minute time frame here. Let's see. So let me zoom in here. So this is when the real break happens, right? This area here. And why does this area isn't the real break? You see the candles, they break through the high of that week. But we never saw a proper third leg, right? We didn't see the third leg properly occur, and price went below, right? So these traders all got stopped out, whoever entered the market right there. But traders who waited for their confirmation, I don't know why did I click this? Yeah. You see what happens with the traders who waited. You see a break above, right? And we got a real break, and we found support, right? We got that first leg there, second leg, and then we got the third leg above, right? So traders who waited for an entry around this area, once the high really truly broke and found support, you see how we have a bullish engulfing there, which closed above the high of the bearish candle. Possibly there are traders who probably took an entry there, right? Targeting around these highs. So a lot of trading strategies do depend heavily on the highs and lows of the higher time frame candles, the weekly and the daily. Me personally, I like to use it as a confluence. I want to see when I'm analyzing the chart, if the high actually broke, I'll be like, okay, that's interesting to see. Something I'll keep an eye on. Yeah. So let's look at so those are high and low. And me personally, when it comes to the marking of the highs and low, if you look at my current charts, I personally like to mark those highs and lows on the monthly time frame, the last month which closed especially. So the June candle especially, or even 2 months, right? I would like to mark off 2 months high and the low, high and the low, because if the monthly candle's high breaks, that is way stronger than probably a daily candle's high breaking, right? And if you look at the weekly, I will mark off the weekly low of the candle. Where is it? Yep, right there, the weekly low, the previous week, and the high of uh, the week, right? So for now, I used to mark off my daily highs and lows, but me at the moment, the way I'm trading, I'm trying to make trading as simple as possible. So all I could tell you is the best thing to do is probably for now mark off your monthly and the weekly high and lows, and if you want to monitor, possibly even look at your daily highs and lows, right? So. Okay, this is a big one, right? This is probably the most important section. This is where we will combine everything we have learned, all the concepts, all the confluences that we have learned till now. So top-down analysis and multi-time frame correlation. So I've mentioned we're going to tie up all the concepts we've learned to understand current market direction and build a hypothesis on where market may head to. We start top-down analysis from the monthly time frame, then moving to a lower time frame. Right? Very simple. Top-down analysis simply means that you start off on a higher time frame on a monthly, and you keep trickling down to the lower time frames. That's what top-down essentially means. And multi-time frame correlation means we see if the multi time frames are in sync. So if once when you're doing your top-down analysis from your monthly time frame and trickling down to the lower time frames, you're going to be seeing that if each and single time frame, what is the trend on this, right? And if they are multi-time frame, which in sync, right? There is a correlation between all of them. They're all bullish or they're all bearish. That means taking longs or short positions would be the most in favor, the highest probable, right? An example, in a bullish trend, if you have your monthly bullish, your weekly bullish, and your daily bullish, this would indicate taking buys would be the highest probability as we trade with the trend. If any one of these time frames is bearish, then we will wait for the time frame to be bullish, right? So me personally, not the way I trade, a lot of traders would wait for even the monthly to be bullish. In this case, I like to see if my weekly and my daily, at least these two time frames, to be in sync, right? Or you could even do something like to wait for your if your monthly is bullish but the weekly is bearish and the daily is bullish. Some traders would see if either two of these time frames are in sync, right? But me personally, I like to see if my weekly and my daily are in sync, right? Because for a monthly time frame to switch a trend from bullish to bearish, it can take a month, it can take few months. I'm not going to wait for a few months to take a trade off, right? So I would wait for my weekly and my bullish and my daily, right? Those are the two time frames I like to see in sync completely. So so here I have mentioned few steps, right? So step one is to analyze. Identify the trend. Identify your trend on the daily and the weekly, right? If you that's how you want to do it. See what the current price is doing, where it's at, right? And then analyze everything. Analyze what the structure is telling us, what are the higher time frame candles telling us, identify any chart patterns, identify the high and low of those higher time frames. What are the supply demand zones that you see, your support and resistance, any gaps or imbalances that you see in the market. What are the higher time frames in sync, right? Are the higher time frames in sync, or any trend lines that make sense to you? Are all time frames in sync? So I mentioned higher time frames twice here, but yes, there are all time frames in sync. So therefore, you can see if there is a multi-time frame correlation. Yeah. So that's how you analyze using all of those tools that we learned. And now build a hypothesis. After you have noticed every time frames all these concepts that we learned. Write down on every time frame, what did you see? What is that time frame telling you? And see if they correlate, right? If all of them have things that stand out to you, and then build a hypothesis. Is it bullish, right? Is it bearish? And maybe possibly where you could see a price head to. And eventually, after we finish the trader section, you would also understand where would you buy and sell and why, right? So till now, we have learned the monthly, the weekly, and the daily time frame. So for now, I would want you to actually start trickling down to the lower time frame. So we always have started off on the monthly. I would start and the weekly and the daily, right? So now I want you to start going down to the lower time frames, the 12-hour, the 4-hour time frame, the 1-hour time frame. And I want you to start looking at the smaller time frames where we have heavier movements, like it's a bit more volatile because it's much more noisier. See what these smaller time frames are telling you. And your smaller time frames are your execution time frames. For example, in this pair, 15 minutes is my execution time frame, right? And if I have seen price come to an area of interest for me, maybe go down to a lower time frame, like the 15-minute here, and see if price is giving me certain entry candles, right? And would it make sense for you to take those entry candles? And why, right? And where would you set your take profits? Setting take profits is something we'll get into deeper, but for now, just analyze the chart and get yourself a bit familiar with these lower time frames. So here is just a quick example, right, on a daily routine if you are trading. So the way I used to do it, and I like to do it, is a pre-market analysis before the start of the market, before you sit down on your desk. Sit down and if you're trading the London session, maybe do a pre-market analysis 2 hours before. Especially if you're a newer trader, you need a bit of a longer time for you to sit down and analyze. And over time, obviously, it's not going to be 2 hours. It's going to become maybe 15 minutes. But for now, maybe analyze 2 hours before London. Understand exactly what's happening, what happened during the Asian session when you were sleeping, according to your time zone. Or if you're someone who's going to trade New York session, do the same thing 2 hours before New York. Sit down and see and analyze and see what happened during the Asian and the London session, right? Then once your session is done, do a post-market analysis, right? You sit down and see after your session is done, if it is London or New York, you sit down and see what actually happened during that session. And also obviously understand, did price play out the way you thought it would be playing out? What did you do wrong? Or analyze your trades, right? If you had taken those trades, and your psychology, right? This is something we'll get deeper into the journaling section of the course. But post-analysis is to see if your analysis played out. Simple, yeah. If possible, I mentioned that to see, if you can see the daily candle closure before sleeping, it sometimes helps as a beginner trader. Maybe because the daily candle can, the daily time frame can switch bias, right? Every single day it can happen, right? Because the start of the week, you thought the weekly and the daily is bullish, but a trading day goes by and the daily candle breaks structure on the daily time frame and goes bearish. So looking at the daily candle closure may help you psychologically, right? Not really necessary, but you could. And also, obviously, I mentioned on Saturday and Sunday, you do a post-week analysis. So every day you do a post-market analysis on every single day. But on Saturday and Sunday, your weekend, when you can, do a whole week breakdown. See what happened throughout the week. Also backtest the whole week if you can, your previous week. So you can see what you did wrong, how it could have played out, right? Or maybe some things that you missed throughout the week, right? Backtest and analyze. Then journaling what trades you missed, trades that you won, trades you lost, your psychology, which we could get deeper into the journaling section. Improvements to be made for the coming week, right? What can you improve? What happened from the previous week? Because trading is a game of improvement, right? You got to improve every single week if you can. So then after all of this post week is done, then you start doing your pre-market analysis, which is after your post-market, right? So here you will start now analyzing for the upcoming week. See your weekly candles closure. What happened? Mark them off, right? Mark off your chart. Mark off points of entry you would like to place your trade at, which we do every single time at a pre-weekly analysis. if you've seen that. Keep an eye on the monthly candle as well. People like to disregard the monthly candle completely when they're trading, but sometimes I do like to look at the monthly candle when it's forming, maybe at the end of the month, and when the candle closes, and also in the middle of the month, right? This is something we'll get into deeper into routines as a trader in part 2 of the course, which is the trader section. Yeah. So I have mentioned here, you have to practice back test and forward test to understand how to analyze. We will build a trade probability hypothesis to determine high, medium, low probability setups in the Confluence trading section and also the SMC section. Still have a few more confluences we have to cover up in the next section, right? And that will be explained in part 2, from indicators to smaller time frame confluences. Analyst section of the course is done now officially. You have now learned every single thing, and the trader section will focus on how to become a trader, right? So before we end this class, I want to show you an example of an analysis, right? How I would do it if I was you. So before you do anything, on the weekly and the daily time frame, mark off your support and resistance the way I showed you to, using the concepts that you have learned till now, the wicks, the quarter points, and the psychological levels, right? Mark them off. I won't do it now because it's going to be a bit too long, but mark them off, right? And once you mark them off, start off your and also mark off your highs and lows of the monthly candle, the highs and low of your weekly candle. So now that you've marked off your chart completely, then you start your analysis, right? You start off here in a monthly time frame, and in this period, for example, I see if I zoom out a bit, I see a bullish trend, right? And also I see the trend is bullish here. If you see these, right? And we see a nice bullish move at the moment. So we are bullish on the monthly. On the weekly, for example, I still see a bullish move, right? We are bullish on the weekly as well, which is a good thing. And on the daily at the moment, we are bullish, but we have now seen a bit of a consolidation and price is trying to break through below, right? So I'm trying to take only long positions, right? So therefore, at the moment, if the daily is flipping bearish, I'm not interested in this till if price breaks through structure above, or actually comes down to an area of certain interest, which we'll look at in the SMC section, where I can get a retest and a push towards the top, right? So I see all of this happening, and if you have your support and resistance drawn out, you can see if price has broken through the support resistance and is getting used as a resistance or support, right? So look at those, then go down to a lower time frame here on the 4-hour time frame. It's reiterating the same thing that I just mentioned. On the daily, we see a consolidation, we see a breakthrough happen, and I see a third leg occur, right? Which I'll zoom in a bit here and show it to you. Hold on. So you see consolidation, right? You see the low here. If I had to mark off the support and resistance here as well, it would be around here, right? So you see how price has broken through that area there, now went up to retest, gave us a massive rejection, and possibly a third leg, possibly, right? But remember, if you're going to be taking these kind of trades, this is going to be an anti-counter, right? This is a counter trend trade. So therefore, not the highest probability, because price can not even make that third leg, confuse everyone and take them out, because on the higher time frames we see price being bullish, right? So the order flow is bullish. So just looking at all of these tiny things, you can understand that, okay, that's going to happen. And also recognize, are there any price gaps around here? I see a price gap there, right? Maybe a price gap which is here, which has been filled out by this wick, right? So that's going to tell you some interesting things. We see this candle here is also telling us there was a massive rejection that happened here. So you take all of these into account and see if you can form a bias on every time frame. Then you combine them all, right? You combine them all and form a proper hypothesis on where price can head to and why. Yeah. All right. So we are done with the class today. So let's see the trader section next.